If you were born before 1971, there is a good chance the IRS and the Social Security Administration are holding money that already belongs to you right now, and nobody at either agency is going to pick up the phone to tell you about it. That's not a scare tactic, and heads up, none of what I'm about to walk you through is personal tax advice. It's general information. Now, let's get into why this happens, because the reason is a lot simpler than most people think. Here's the setup. Most seniors file the same tax return every year, keep the same withholding they set up years ago, and quietly assume that if there were extra money available to them, their tax preparer or their pension company would have said something. That assumption is wrong, and it's costing the average retiree real money every single month. Not because anyone did anything illegal, not because of some loophole that's about to close, just because the system is built so that you have to ask for what's yours, in writing on a specific form, and almost nobody knows which form to ask for. Take a retired teacher in Ohio, 68 years old, collecting a modest pension on top of Social Security. For 3 years straight, her pension company withheld a flat 10% for federal taxes. No questions asked, because that's simply the default rate when nobody tells them otherwise. Every April, she got a refund check and felt like she'd done something smart. In reality, she'd been handing the government an interest-free loan of roughly $2,000 a year, money that could have been sitting in her checking account the entire time instead of showing up 11 months late as a refund. That's one form. There are 4 more just like it, and the very last one on this list has a bigger monthly dollar impact than all the others combined, for the retirees who happen to qualify for it. Where does this authority even come from? This isn't a rumor, and it isn't some obscure tax strategy dreamed up by an advisor trying to sell you something you don't need. Every single rule I'm about to walk you through comes directly from IRS.gov, from SSA.gov, or from CMS.gov, the federal agency that actually runs Medicare. These are current, published rules for the 2026 tax and benefit year. For each one, I'll give you the form number, exactly what it does, and a real dollar example using realistic income figures so you can go verify every bit of it yourself before you act on any of it. Let's start with the form that touches the most people first, and we'll build from there toward the one with the biggest payoff. Number 1, Form W4P, and this one is about your pension or IRA withholding. Here's the rule in plain English. If you receive a pension, an annuity, or regular distributions from a traditional IRA, the company sending you that money withholds federal tax using a default calculation, unless you specifically tell them otherwise using Form W4P. That default is very often too high, especially now that seniors have access to bigger deductions than most generic withholding tables assume. Here's the dollar impact. Say you're 67, single, and your pension pays you $3,200 a month, which comes to $38,400 a year. If your provider is withholding at a flat 10%, that's roughly $3,840 pulled out of your check across the year. But once you factor in your regular standard deduction, the additional standard deduction available to seniors 65 and older, and the temporary senior bonus deduction created under the 2025 tax law, your actual federal tax liability on that pension income could realistically be closer to $900 or $1,000. That's a gap of nearly $3,000 a year, or somewhere around $250 a month sitting with the IRS instead of in your checking account where it belongs. What do most retirees do wrong here? They filled out their withholding paperwork once, back when the pension first started, and never touched it again. Deductions change, tax law changes, your income situation changes. Your withholding is supposed to move along with all of that, and it simply doesn't unless you file a new W4P. Here's the part that surprises people the most. Filing a new W4P doesn't wait for tax season to help you. Once your pension administrator or IRA custodian processes it, your very next monthly payment reflects the new withholding amount, not next April, next month. And this isn't only a pension problem. The same form controls withholding on regular IRA distributions, and IRA custodians are often even more conservative with their default rates than pension administrators because they have no visibility at all into your other income or deductions. A retiree taking $4,000 a month from a traditional IRA with a custodian defaulting to a flat withholding percentage can easily be over-withheld by several $100s a month once real deductions are factored in. Most people never ask their custodian what rate they're using in the first place. They just assume whatever gets deposited is correct. Most people also stop here and assume the form is a one-time task, filed once and forgotten. It isn't. If your pension amount changes, if you start a new IRA distribution schedule, or if the tax law changes the deductions available to you, as it did with the temporary senior bonus deduction, that's a signal to revisit this form again, not just file it once and move on for the rest of your life. Now here's where it gets important, because this next form touches almost every single Social Security recipient in the country, whether they realize it or not. Number 2, Form W-4V, voluntary withholding for Social Security. Most people genuinely don't realize this, but Social Security does not withhold a single dollar in federal tax by default. Zero, unless you specifically ask it to. For some retirees, that's completely fine if none of your Social Security benefit ends up being taxable. You truly don't need any withholding at all. But for the millions of seniors whose benefit is partially taxable because of pension income, IRA withdrawals, or part-time work, that zero withholding default turns into an unpleasant surprise every April, sometimes with an underpayment penalty attached on top of the tax bill itself. Here's a concrete case. A married couple, both 70 years old, drawing a combined $41,000 a year in Social Security benefits. Years ago, back when their income was noticeably higher, they set their withholding at 22%, the highest rate available on the form. Today, with their income lower and their standard deduction higher, their real effective tax rate on that benefit is closer to 8%. That mismatch means they're overpaying by roughly $200 a month, money that should be paying for groceries and prescriptions right now instead of sitting at the Treasury waiting for a refund next spring. Form W-4V gives you exactly 4 withholding options to choose from: 7%, 10%, 12%, or 22%. You pick whichever one lands closest to your actual liability based on your current income. You can submit it 3 different ways: through your personal My Social Security account online, by mailing it to your local field office, or by handing it in person. Most people set this rate once, right when their benefits started, and never revisit it again, even after retiring fully, paying off a mortgage, losing a spouse's income, or picking up part-time work. If your financial picture has shifted at all since you first set that rate, it takes about 5 minutes to check whether it still makes sense for where you are today. Here's the flip side most people never think about. Up to 85% of your Social Security benefit can be taxable depending on your combined income, which the Social Security Administration calculates using your adjusted gross income, any tax-exempt interest, and half of your annual benefit added together. If that combined figure crosses certain thresholds, a portion of your benefit becomes taxable for the very first time, often the same year you start a pension or begin required minimum distributions. That's exactly the moment people get blindsided in April, because the income crossed a threshold and the withholding never caught up. Most people also don't realize this form works in reverse just as easily. If your income drops, say after a spouse passes away and household income falls, or after you stop a part-time job, you can lower your withholding rate the same way you raised it, using the exact same form. Number 3, and this is a form that was quite literally built with you in mind. Form 1040-SR. If you're 65 or older, you're allowed to file your federal tax return on Form 1040-SR instead of the standard 1040. It isn't a different tax rate, and it isn't some special program you have to apply for. It's simply a version of the return structured around the income sources and deductions that actually apply to people your age. Larger print, yes, but more importantly, it comes with a built-in worksheet for the additional standard deduction for seniors, a cleaner layout specifically for reporting Social Security and pension income, and it makes the current senior bonus deduction under Schedule 1A far harder to accidentally overlook than it is when it's buried inside the standard form. Here's why this matters in real dollars. The additional standard deduction for a single, senior 65 or older, adds roughly $2,000 on top of the regular standard deduction. And for a married couple where both spouses are 65 or older, that additional amount is roughly doubled. Miss it entirely or have it applied incorrectly, and you end up paying tax on income that was never supposed to be taxable in the first place. Most major tax software applies this automatically once you confirm your correct birth date in your profile. So if you file your own return, that's the one field worth double checking before you submit. But if a preparer is filing your return by hand or working off an older template they've used for years, it's worth asking directly, are you filing this on the 1040-SR? And if the answer is no, ask exactly why not. Here's the part that catches people off guard. Eligibility for the 1040-SR is based on turning 65 by the end of the tax year. It has nothing to do with whether you're still working, still filing jointly with a younger spouse, or already retired. A lot of seniors assume it only applies to people fully retired and living purely on fixed income, and skip it because they still have part-time earnings or investment income. That assumption isn't in the rule anywhere. If you're 65 or older, the option is available to you regardless of what else is on your return. Most people stop there and think the form is just cosmetic, larger font, and nothing else. But the layout difference actually changes how easy it is to catch an error. On the standard 1040, the senior deduction gets folded into a worksheet most filers never open. On the 1040-SR, it's printed directly on the face of the form, which is exactly why fewer 1040-SR filers miss it compared to standard 1040 filers in the same age bracket. Now let's talk about a mistake that can quietly cost tens of thousands of dollars over time, and it has almost nothing to do with this year's return at all. Number 4, Form 8606, tracking your IRA basis. Here's the situation this form form exists to solve. Traditional IRA contributions are usually tax deductible, meaning you put money in, it lowers your taxable income for that year, and you pay tax later when you withdraw it. But some people, especially in years when their income was too high to qualify for the deduction, made contributions using money they'd already paid income tax on. That's called a non-deductible contribution, and it creates something the IRS calls basis, meaning money that is not supposed to be taxed a second time on the way out. The problem is this. If that basis was never documented on Form 8606 at the time those contributions were actually made, the IRS has no official record that it exists. When you eventually take distributions, especially required minimum distributions in retirement, the custodian reports the entire amount as taxable income, and you end up paying income tax a second time on money you already paid tax on once. Consider someone who made roughly $22,000 in non-deductible IRA contributions across several years back in the 1990s, but the accountant handling their return at the time never filed the form. Decades later, now taking required distributions in retirement, that person is being taxed on money that should have come out completely tax-free. At a 22% federal rate, that's close to $4,800 in tax that never should have been owed. And depending on how the distributions are structured, that mistake can keep repeating year after year if it's never corrected. If you're not certain whether you ever made non-deductible IRA contributions, or if you've ever done what's called a backdoor Roth conversion, this is genuinely worth a direct conversation with a CPA, because past returns can sometimes be amended to formally establish that basis even many years after the fact. Here's the part that makes this one so easy to miss. This form isn't filed with your custodian, and your custodian isn't the one tracking it. It's filed with the IRS as part of your annual return, which means the responsibility to keep the paper trail sits entirely with you, not with whoever holds your account. If you've changed accountants over the years, moved IRAs between custodians, or simply lost track of old paperwork, that basis can quietly disappear from the record, even if you did everything correctly the year you made the contribution. Most people stop and assume this only matters for wealthy retirees with complicated portfolios. It doesn't. Anyone who ever contributed to a traditional IRA during a year their income was too high for the deduction, even a single year, decades ago, needs to know whether Form 8606 was filed for that specific year. If you genuinely don't know, that's reason enough to ask a CPA to check your filing history before your next distribution. And now, the form with the biggest monthly financial impact of anything on this list for the retirees it actually applies to. Number 5, Form SSA 44, the Medicare IRMAA appeal. To understand why this one matters so much, you first need to understand IRMAA, short for the Income-Related Monthly Adjustment Amount. It's a surcharge Medicare adds directly on top of your regular Part B premium if your income lands above certain thresholds. Here's the actual number for this year. The standard Medicare Part B premium in 2026 is $202.90 a month for most beneficiaries. But Medicare doesn't look at what you're earning right now, it looks at your tax return from 2 years earlier, which means your 2026 premium is being calculated using your 2024 income. For a single filer whose 2024 modified adjusted gross income came in above $109,000, or a married couple filing jointly above $218,000, the surcharge kicks in. At the first tier, that pushes your total monthly Part B premium up to around $284. At the very top tier, the total climbs all the way to roughly $690 a month per person, which for a married couple, both on Medicare, can mean well over $1,000 a month combined. Here's the trap that catches so many retirees completely off guard. If you retired at some point during 2024, worked even part of that year, sold a business, took a larger pension payout, or had any kind of one-time income spike, that elevated 2024 income is exactly what's setting your Medicare premium right now in 2026, even though your actual income today might be a small fraction of what it was back then. Take a couple, both 67 years old, who each worked through the middle of 2024 before fully retiring, which pushed their combined income for that specific year up to around $240,000. That single elevated year put both of them into an IRMAA surcharge tier starting in 2026. Their real income today, living on Social Security along with a modest pension, is under $60,000 combined. They're paying a Medicare surcharge based on income they no longer have and will never have again. And the overwhelming majority of people in that exact situation never even realize a fix is available. The fix is Form SSA 44, formerly known as a life-changing event appeal. It allows you to ask Social Security to base your premium on your current lower income instead of the 2-year-old figure sitting in the system. There are several qualifying events recognized under this form: retirement or a reduction in work hours, marriage, divorce, the death of a spouse, loss of pension income, loss of income-producing property, such as a rental you no longer own, or a one-time employer settlement payment. Retirement by itself is enough to qualify you. For that couple, filing this one form each and documenting their actual current 2026 income dropped both of their premiums back down to the standard rate. Combined, that recovered several $100s a month for the household, and because they filed it early in the calendar year, the correction was applied retroactively to months they'd already overpaid at the higher rate.
The overwhelming majority of people never file this form, and it isn't because they don't need it, it's simply because they've never heard that it exists. Now you have. Here's something else worth knowing. This appeal isn't limited to a single filing window tied to open enrollment, and you don't need to wait for a specific time of year to submit it. You can file Form SSA 44 at any point once a qualifying event happens, and the sooner you file after the event, the sooner the correction takes effect and the more retroactive overpayment you're likely to recover. Most people also assume this only applies once, right after retiring, and never think to check it again. But qualifying events can happen more than once. If a spouse passes away years into retirement, if pension income is later reduced or eliminated, or if a rental property is sold well after the original retirement date, each of those is its own separate qualifying event, and each one is worth its own appeal using the same form. So here's exactly what to do this week ranked in order of dollar impact. If you're currently paying a Medicare surcharge and you've had any recent change in income, work status, or marital status, start with Form SSA 44 at ssa.gov. That's the fastest and highest impact fix on this entire list. If you receive pension or IRA distributions, check your current withholding against Form W4P and adjust it directly with your plan administrator if it looks too high for your actual income. If you collect Social Security, log into your My Social Security account and confirm your Form W4V withholding rate still matches where your income actually stands today. Ask your tax preparer directly whether your return is being filed on Form 1040-SR this year, and if not, why not? And if you've ever made a non-deductible IRA contribution at any point in your working life, bring up Form 8606 with a CPA before your next required distribution goes out. None of these 5 forms are automatic. None of them get filed on your behalf without you asking. The money is already legally yours, sitting exactly where it's always been, and the only thing standing between you and it is about 20 minutes and a form you can download for free today, directly from the source. If this helped clear something up for you, subscribe, because every single week I break down one more rule the IRS and Social Security rarely explain in plain language, and there's a good chance the next one applies to you too.